Good afternoon. I'm Desmond Lochman, and I would like to welcome you all to this afternoon's event on the International Monetary Fund's COVID-19 challenge. And it's my particular pleasure to welcome Geoffrey Okamoto, the International Monetary Fund's first Deputy Managing Director, to this event. Just by way of introduction, I might say that the coronavirus pandemic has brought in its wake the worst global economic crisis in the past 90-year period. Practically every economy around the world is now suffering from their deepest economic recession in the past 90 years, and they're experiencing levels of unemployment that are reminiscent of those in the 1930s. At the same time, what we're seeing is that global supply chains have been interrupted and world trade has been paralyzed. Meanwhile, the emerging market economies have been hit by a perfect storm of a destructive pandemic, depressed international commodity prices, a major reversal of capital flows, and weak external demand for their exports. As has been the case with previous economic crises, the IMF is now again being thrust into a central role in helping to resolve this crisis. It's for this reason that I'm particularly delighted to have as senior official as Geoffrey Okamoto to take time out of his busy schedule to join me in a conversation on the current state of the world economy and on the IMF's response to the serious challenge to the maintenance of global economic prosperity. By way of background, I should mention that as the IMF's first Deputy Managing Director, Geoffrey is the second highest official in that organization. Before moving to the IMF, Geoffrey served as Acting Assistant Secretary for the US Treasury's International Finance Department, and he also held senior roles in the US Senate's Banking Committee. Before starting the conversation, I'd like to congratulate Geoffrey on his recent appointment to the IMF and wish him the best of luck in what is likely to be the most challenging period in the IMF's 75-year history. With those words of introduction, I thought we might start our conversation by having Geoffrey provide us with an overview of how the IMF is now viewing the world economic outlook. So perhaps, Geoffrey, if you'd like to just say a few introductory words, how are you seeing the world economic outlook? You know, a lot has changed since the last WEO put out by the IMF in April, and it would be just interesting to hear your views on where you think we're heading.
Great, thank you, and good afternoon, Desmond, and to all of you tuning into to the event this afternoon. It's great to be here. I think, Desmond, the last time you and I saw each other in person was actually seated together at an AEI dinner, which just shows how different times are now that we're able to do these virtually. But one day we'll get back to the in-person meetings. But good to have you all tuned in. I think the first thing to just kind of keep in mind is, first and foremost, this is a health crisis. And there are many people that are continuing to suffer at the hands of the virus itself. So obviously here in the United States and around the world, hundreds of thousands of people have died, and many more remain at risk. So first and foremost, we're sensitive to the real-time health consequences that are being felt throughout the world. In terms of the economics, this is something that we're going to be talking a bit more about next week when we release our update to our forecast formally. So I don't want to get too far ahead of where we're going to be in releasing that data next week. But suffice to say that the last time we released our assessments was in April. Since then, some of the higher frequency data has come in a little bit below where we normally projected it. A lot of that has to do with the duration of the lockdown being longer than we expected, and so therefore the economic contraction that was experienced in the immediate wake of the onset of the virus was deeper than we expected. And that has implications for how long it's going to take to begin rebuilding. You're starting to see some of that activity pick up now, particularly in some of the countries like China that exited lockdowns first. So we hope that some of that data holds some promise to those countries that are now beginning to see their lockdowns lifted. For example, here in Washington, D.C., I believe our local authorities are considering moving to a phase 2 reopening on Monday. But there's obviously still a lot of uncertainty in the forecast, and we'll appropriately, caveat that in our assessments next week. But that's where we stand as of today.
Thank you. I guess in the forecast, you're going to have once again a range of forecasts depending on upside risks and downside risks. Right now, it would seem that one of the downside risks seems to be that the coronavirus globally, the number of people infected seems to be increasing. I'm thinking that even within the United States, what we're seeing is something like 21 states, the numbers look like they're going up. So, the notion that one might have to have another lockdown, I guess, can't be excluded in many places. I guess on the upside, there are upside risks, in the sense that if promising treatments come along, or if vaccines come along, that would make the crisis a lot more manageable. And similarly, if one had additional stimulus, you could do that. But I guess you're going to be doing a range of forecasts when you release the numbers.
That's true, yeah, and just like we did in April, I think we're kind of having a look at what those scenarios are and how they play out. Certainly, there is a scenario where there's another lockdown envisioned, either the same, worse, or a little lighter than the one many people just experienced. And there's also a lot of interaction with where the path of the virus itself ends up taking us, and where the health community ends up seeing advances or not in terms of therapeutics and vaccine development. It's for that reason that the IMF is kind of in unprecedented coordination mode with public health officials and public health experts and epidemiologists. This is not something that, as Desmond, you may recall when you were here at the IMF, this is not something that was necessarily a built-in competency here at the fund, and not one that we're necessarily trying to build in-house. I think there's expertise being built up here, but we're also trying to rely on these experts that exist in the field, because their assessments of where some of these innovations and developments could be, as well as what kind of lockdown measures ended up being effective from a public health perspective, could inform the economic path going forward, and that's very relevant for our projections.
Yeah, I guess that if there were to be a second wave of this virus, the lockdowns won't be as severe. We've learned quite a lot about that. Presumably they're going to be a lot more targeted. That we're now seeing that there's certain parts of the population, the older part of the population, are vulnerable. So there's no reason to lock down the whole economy to protect the older people. One could have selective kind of lockdowns. So I'd imagine that, if you were to get a second wave, it wouldn't be a good thing, from an economic, certainly from a health point of view, it would be a disaster. But from an economic point of view, it might be less severe than the first wave, in that you could draw the lessons from experience of countries that have been successful, and have something that's a lot more targeted than what we had the first time around.
I think that's right, Desmond. We're, as an institution, but I think as an economy, both in the United States and around the world, there's institutional learning and policy learning that's going on here. So none of these decisions are being made without the lessons that we're gleaning from even the recent lockdown experience. When we entered this, you can call it the lockdown phase, or kind of the initial onslaught of the virus in March, we quickly went to work to kind of assemble across the world what types of economic support and related measures are being put in place. I think one thing that we're trying to help countries do right now is assess what what worked and what didn't, what kind of policies make sense in the next few months to in the next phase that are going to help them stabilize and eventually rebuild their economies.
Well, that is really a great role that the IMF can play. That just going back to my days at the IMF, it seemed that the IMF would be the provider of information about whether fiscal policies or monetary policies in this, that, or the other country worked. And one could really share that experience with the other membership. It looks like the IMF's in a central role, that could be one of the functions that they can really play rather effectively now. But let me turn then to the question of how has the IMF been adapting its policies? What has it really been doing to really meet the challenge where we haven't had a crisis like this? We haven't had a economic crisis that affects every country around the globe in a pretty bad way. So the demands on the IMF and the resources must be very high. I wonder whether you want to just say a word or two about how the IMF's been responding, what kind of initiatives they've been looking at.
Yeah, I think you put it well. This is a crisis that the world has never seen. As Kristalina likes to say, a crisis like no other. And that includes something that we haven't seen as an institution in our entire history. So even though we have played roles and tried to fight fires across our existence, this is something that is incredibly unique in a few ways. One is it is truly global. So this is not like past crises that were somewhat localized in regions, or even in 2008, where it was in advanced economies in the financial sector, right, where it started. This is fundamentally different in its global scope and scale, and the speed at which it came on. So if you think about where we began this year, we thought that the vast majority of countries were going to experience per capita income growth. In other words, more prosperity in 2020 than they had in 2019. That is fully going to reverse by our assessments. So by the end of this year, we believe it's going to flip the other way, where 90% of countries are actually going to experience negative per capita income growth. And that's a complete reversal that came on just in the span of a few months. So what have we done for it? I think there's a few things that we've put to work quite quickly. One is we've activated our emergency financing facilities. So we have a few instruments that are fast dispersing, which you need at a time when you're fighting a crisis that is moving quite quickly. We've doubled our access limits for those facilities to allow countries to draw the resources they need when they need them. We've also put new facilities in place. So we for the first time in 10 years, we put in a new instrument called the SLL. It's an instrument that is complementary in our toolkit that allows good creditworthy countries to approach the fund early and get. You can think of it as an insurance policy against some of the risks that they may face in terms of capital flows and other pressures they can face in the coming months. And then I think we've really revamped how we're delivering capacity development or technical assistance. This is unique because we're all working from home. My first day at the IMF was actually spent at home. In our obviously we're still working from home, or most of us still are. And so to be able to deliver capacity development to a country that sorely needs some advice on how to manage some of these economic issues while the world is in such flux is a real challenge. But our team has stepped up to the task. Our staff is working 24 hours a day, 7 days a week from home on a crisis that they've never seen before to try and deliver on all these initiatives.
This new facility, the SLL, that's different from the flexible credit line. Is that so? That's something different from what the IMF extended to Chile and to Peru.
That's correct. So the Chile and Peru accessed an FC, or we put FCLs in place for Chile and Peru just over the past month. The SL is a new instrument. It's the same qualification criteria. So in other words, we like to say that countries have to have platinum policies or platinum frameworks in place, which means to say that these are well-governed countries with well understood policy frameworks that certainly capital markets and astute people that are on this call can understand and interpret. But they're not immune from challenges. And I think one thing that's been quite helpful is the Federal Reserve and other central banks have been instrumental in putting in swap lines for certain emerging market economies early in the process. That has I think been one of the things that has attenuated some of the volatility that we saw earlier in the crisis in terms of capital flows. But we put this instrument in place for countries that need a lower level of access potentially than what the FCL would offer, or over time provide an opportunity for countries that are on an FCL to step down to an SLL as a way to, as they build up their internal buffers and their policy tools.
Just in terms of the FCL, are there other countries that would pre-qualify like Chile and Peru, or is there a list of countries that would pre-qualify?
I think there's certainly a universe of countries that qualifies in the sense that not every country does qualify for these instruments. We obviously don't share a list with the public on who we believe to be in that bucket or not, but yeah, I think one thing that we are in active discussions with countries that do qualify for these facilities and are exploring what options they have to assess kind of the landscape ahead and the risks that they see is what tools do we have that could be useful to them. Part of the challenge is we want countries to approach us early enough in the process to where we can arrest the problems early on with less, you can think of it as less of a dramatic policy shift and then less financial resources from the IMF. But that requires a two-way conversation that we have early on, and so we're in active discussions with a few of those countries at the moment.
Right. You mentioned that the Fed swaps were really very helpful, but I guess what must also have been very helpful is the Fed following a policy of another round of quantitative easing on a really very big scale, all of the interventions, the bond, increasing the size of the balance sheet by $2 trillion. That really seems to have calmed markets down and taken the pressure off the emerging markets. But I wonder whether you could just say how many countries you've provided financing to, something like 70 countries, and you're talking about something like $21 billion. Is that roughly the amount? That's
correct. Yeah, and I don't think we're done yet. There are still countries that are in the queue for example, for emergency assistance that we're continuing to work through, and countries that have their reviews for their existing programs in place that we're considering augmentations for.
Right, but I guess the next phase is going to be some of the larger countries, particularly if liquidity conditions in the emerging markets change, for any reason you get another round of capital withdrawals, that I'm just looking, there are a whole bunch of countries, large emerging market countries, places like Brazil and Turkey and South Africa, that once seeing their currencies really under quite a lot of pressure, some of these currencies have lost 25% since the beginning of the year. So, one would think that many of these countries are already going to have to come to the IMF for large programs, and presumably those kind of countries, there will have to be stricter conditionality than what one's done to date with the smaller countries.
We have a very robust internal policy framework that governs what kind of risk we as a fund are willing to take on and what kind of risk mitigation options we have, including program conditionality is appropriate for different sizes of programs. So you may be familiar, Desmond, with our exceptional access policy, which isn't a hard limit on the amount we lend, but it does require a higher bar to be met for certain size programs to come through our executive board. That's certainly going to be a challenge. This isn't going to fall evenly necessarily on all these countries the same way. Brazil, for example, has very robust internal buffers that it can utilize in the intervening period here. But we're open to have these discussions with countries and are with some of the ones that that people have top of mind. But again, the thing to emphasize here is getting the assistance you need quickly. So in other words, coming to us earlier, putting the right policies in place earlier on so that those are well understood by certainly financial markets for those that have substantial and utilize market access, but also get the requisite financial support that is needed to kind of weather the conditions that, as you've seen, Desmond, can turn on a dime, right? I mean, these markets can be quite volatile at times, and not all emerging markets necessarily are viewed by capital markets the same way. So, in other words, a problem in one emerging market can easily spill over into the sentiment of a different one, which is tough to manage.
Yeah, no, I'd agree with you totally that if you had trouble in a large emerging market economy, that would really spill over very quickly. And I totally agree with you that the earlier that they come to the IMF for assistance, the easier it is to handle the crisis. But I guess for a lot of these countries, their problems, there's a stigma attached to coming back to the IMF. I'm thinking, many of the Asian countries, feel the experience of 1998, they still politically, that is something that they've got to consider. And Latin American countries aren't too enthusiastic to come to the IMF. I remember Stan Fisher used to say that countries would come to the IMF with the same enthusiasm that patients go and see their oncologist. But what might one do, to lessen the stigma? You're actually adapting some of your lending policies for that period. And I've noticed that one of the things that you've mentioned in speeches is that this isn't your grandfather's IMF. I just wonder whether you can elaborate on that.
Sure. No, that's a great point. And there's a lot of history with the institution. The IMF has done a lot of good work over the years in trying to contain crises, and for all the unsung heroes that have warded off crises that we never even heard of, right? And so that's the world will never fully appreciate, right? All the everything that was bad that did not actually come to pass as a result of the hard work that people have done here. But that's with the understanding that certainly the stigma issue, as you kind of put it, is something that we grapple with. It's something that I think Crystalline and I are running towards, right, as a problem. And so to your point on my quote earlier from Bloomberg, which was this is not your grandfather's IMF, is appropriate. We are not necessarily the same institution that we were 30 years ago. There's, like I said earlier, institutional learning and evolution that is happening in terms of what we understand works, what doesn't, understanding the political constraints that countries face and what that means in terms of the ability to implement a program and get your economy back on track. It begins with kind of the understanding, the shared understanding that certainly, I and others have with countries, which is we want more prosperity and more growth and better livelihoods for average people, right? So we want the average person to understand at the end of the day that the IMF is a force for good in their country and is reinforcing good governance and good transparency and accountability and well understood policy frameworks and sound government spending and money that they can trust and find to be stable. So these are the same things that we we think we share these values with our client countries, and it's on that basis that we try to establish a relationship that we can then build on. And by the way, it doesn't necessarily mean that every country needs a loan from the IMF. There are probably situations where another loan actually isn't really value add or helpful to a country. But as you mentioned earlier, we are very helpful in terms of capacity development, sharing what lessons have worked in other countries, and trying to adapt them to the country that wants to use them, and evaluate their usefulness over time.
No, that's certainly the case. Somebody sent in a question, if I may just interject it, it does seem to be a pertinent question, just going back to the economic outlook. They're raising the question of economic protectionism. Has that led to a further escalation of the crisis? And I think that I could perhaps elaborate on the question in that in 2019, we were already seeing a slowing in the global economy, as a fallout from the United States-China trade war. So I was wondering, how do you see, this issue of protection? That's got to be another risk to the global outlook.
Certainly, we think the world is a better place with freer movement of capital and ideas and people. I think there's quite a bit of, I think some of where these trade issues are centered is on criticisms or at least identification of the shortcomings of the existing multilateral trading framework. And I think in some respects, right, some of that criticism is well placed, and I know the WTO and some of their membership are actively engaged in a discussion on how to improve that system so that it works better for all those involved. From where we sit at the IMF, this is largely an analytical exercise, right? So we are not necessarily the designer of these rules or dispute resolution systems, but do try to bring clarity to the upside and downside risks that various choices and alternatives present to countries. And one thing that we were worried about earlier on in the crisis was restrictions of goods and in particular food in some countries, where export restrictions were going to be put in place that were going to be quite damaging. That seems to have attenuated a bit, but I think it has shown us that our trading system is quite flexible at a minimum, that it's been able to deal with some of these real-time economic shocks from around the world. We should find value in preserving the good aspects of that, which is a system based on flexibility and trust and redundancy, and see what we can do to further those objectives.
And then also what I guess you try to do is to get some sort of multilateral agreement on issues like this, to make sure that imbalances don't develop in the global economy, on the balance of payment side that might lead to this sort of pressure. So in your discussions at the G20, presumably the IMF is an important voice for an open trading system that is to everybody's benefit.
That's right. I mean, what we've learned, we were fortunate to enter into this crisis with a very different economic situation than we did during the Great Depression, which is we not only have an IMF that is well-resourced and able to provide technical assistance and financing, but we have a world that is committed to economic efficiency and economic prosperity, and more aligned in that direction than we had during the Great Depression. That's a source of strength. Again, it's a source of strength that we came into that with this. It's not to say that some of these criticisms don't have validity. Several of them do, and there's some difference of opinion, it seems, on how exactly to remedy those. But I know that that energy, what we are encouraging in the G20 and others, we are encouraging those that are interested to proactively work towards getting a solution to those in place so that we can get on with making the world a more prosperous place.
Right. And presumably that gets done better in a multilateral setting rather than countries taking bilateral action against one another, and then one just gets the escalation. I would worry a little in terms of, the political fallout from an economic depression as deep as this. I'm just thinking back to 2008, when we had the great economic recession. It wasn't an accident that we got populism around the world, in a more difficult political environment. A lot of countries had found that their political center really just kind of retreated, and we got extremes on both sides that just make governance a lot more difficult. Hopefully, that I guess would be the reason, the urgency that one really has to get a recovery going very quickly so as to avoid that. But let me ask you, in terms of the adequacy of the IMF's resources, that we will get large countries coming to the IMF, how do you see that? If you could just explain, how much usable resources the IMF has, what might be done if the needs become rather large, what are the plans to augment the IMF resources if that is necessary. But it would be good to hear, how you see the adequacy of the IMF resources at present.
We're fortunate in that, relative to even the 2008 global financial crisis, we have vastly more resources at our disposal. A lot of that can be attributed to even recent decisions that have been taken in the past few months with respect to doubling of our credit line, our multilateral credit line with the membership called New Arrangements to Borrow, or the NAB. So the NAB was doubled by decision late last year. And we're fortunate that the U.S. Congress and other legislatures have moved quickly to put that authorization in place and lock in that doubling. That is encouraging from two things, in two respects. One, the envelope that we have is more than sufficient, we think, then to meet the needs that we foresee, including some of our downside scenarios. And then two, if we were to hit a scenario where the demands for resources exceeded what we had available in terms of quota, multilateral borrowing through the NAB, and then bilateral borrowing that we have set up with specific countries. If we were to somehow exceed that, I think the ability to reach decision on the NAB and the ability to move quickly ahead, 2 years ahead of schedule to put that doubling in place gives us some comfort that if we were to need resources and were to demonstrate the case, we'd be able to approach our membership with confidence that we'd be able to get the resources that we need. So,
but currently right now, the IMF has around about $1 trillion of usable resources? That's correct. About $1 trillion in what I like to call, unused financial firepower. So that's ready to be deployed. And the NAB, the doubling of the NAB, how much money would that have involved? I believe that takes us to north of $650 billion just in NAB resources. So these ideas floating around about issuing new SDRs, that's something that one really doesn't need. I think at the moment, there's still an active discussion on special drawing rights and whether to provide a new issuance like we did in 2008. Our membership is split on that at the moment, but I think the membership has rightly identified the problem, right? So the problem is that countries need liquidity, even those that are really poor and have very low capacity. The debate, right, is how targeted is a general SDR allocation towards getting at that problem. We're not there yet in terms of a general SDR allocation. In the meantime, I think I've taken on the challenge of trying to assess or take on board this is a legitimate problem that's been identified and seeing what can be done with the existing stock of special drawing rights to try and get at that problem. So there's some very creative work that we're engaged in at the fund right now within the constraints of the existing SDR allocation, and we're going to see where we end up. It's a bit premature because we haven't had these discussions fully with
a lot of our membership yet. And obviously we have to kind of balance the needs that have been identified from those countries that want additional SDRs and the willingness of the countries that have the SDRs. And so this is a conversation we have to have with both. But we are hopeful that we can reach some conclusion on that soon, so that we can get at the problem with what we already have.
Yeah, I guess one of the things that make the IMF's resources a lot more plentiful right now is that Europe is in a very different position than it was in 2008. That the ECB and the European Stability Mechanism, all of those have really developed ways of helping Europe if Europe really got into trouble. So that, I guess, really helps the IMF, that you're not expecting calls on, from the Eurozone countries. They would handle any problems they had amongst themselves. How do you see the IMF operating in Europe? You're likely to have calls from countries outside of the Eurozone?
That's correct. I mean, I think, to your first point, there's a lot that's changed over the past 10 years. One thing that has changed is there are different European institutions in place. Also different institutions in place in other parts of the world as well, including Asia and Africa and elsewhere. And so the IMF is still very firmly at the center of this, you want to think of it, the global financial safety net. And that has challenged us, right, in a good way, to develop, modalities of working with these institutions in a way that may not require necessarily primary reliance, in the case of Europe, on the IMF's financial resources, but does, I think, benefit from the, whether it's our data collection or our technical assessments or even just our credibility with the marketplace, some of those aspects of what we do. In terms of involvement with Europe, there's two aspects of that. One is, Europe is a big part of our membership. Some of those members are some of our strongest financial supporters, so we're quite thankful for their continued financial support of the institution. And then we do have some countries in Europe that have approached us on IMF programs. We're working with them to see what, in some cases we have programs in place, for example, in some of the European periphery in the Balkans, for example. We also have a program in place now for recently for Ukraine. So this is there are good working relationships we have, and we want to see, again, for those countries that are experiencing difficulties or have a challenge, approach us. It doesn't mean you have to borrow. We have these we have technical assistance that's quite active in Europe, in a lot of places as well, where that's achieving good objectives.
Yeah, the question's coming. Could you say a word of how you see the debt service suspension initiative? How successful do you think that has been? They're also asking, what's your assessment of sovereign debt risk in low countries and China's engagement on debt matters?
Sure. We along with the World Bank called for the G20 to implement the DSSI, the Debt Service Suspension Initiative, that would allow countries to free up some of the money they would have been paying in debt service to official G20 official credits, and redirect that towards pandemic-related response, whether that's transfer payments for social safety nets that had to be shored up, or spending in the health sector to try and contain the spread. There's also a side or an initiative that the G20 themselves called for, that's an analog to that in the private sector, which the Institute for International Finance has stood up, that provides for voluntary participation by private credits in the same respect. I think in the official G20 DSSI side of things, I think we're up to about 36 countries that are intending or are currently participating. There are more that are currently discussing it. There are certainly implementation challenges moving quickly on something like this. Some of those questions continue to be ironed out and are before the G20 at the moment, so I don't want to get ahead of where they're going to be in terms of settling a few of those issues. But one thing that you and others have rightly identified, and I think your questioner has as well, is the financing landscape for countries has gotten more complicated over the past 10 years. So with a period of lower interest rates and a proliferation of both official and private sector creditors in the marketplace, countries have had plenty of opportunity of windows and parties to borrow from, and they have. And some of that has been for very productive use, and some of it may not have been. But suffice to say, countries are where they are at the moment. The issue a few years ago that we were all discussing, which was debt sustainability, those concerns effectively got accelerated by the pandemic. No one's debt situation has gotten better in the last few months as a result of anything that's transpired. In working with that network of creditors that are different from the traditional G20, or really the Paris Club official sector creditors, that's a challenge. And whether you're the private sector or you're China or another non-Paris Club country, you haven't had to do this before at this kind of scale. And that requires a certain amount of internal policy development and coordination, including liaising with us and with the other private official sector creditors in the G7 and the Paris Club. That is just it's novel and different, and that is creating some challenges.
Yeah, what you're saying about very easy liquidity conditions really created a lot of money flowing to countries. And one of the problems must be that there are a multiplicity of providers. It's not like in the old days where you had a few large New York center banks providing the financing, so it would be easy to get them in the room. The private sector must be a lot more difficult to herd. But I'm struck by the size of the debt, that the emerging market economies have something like $70 trillion in debt, which means that it really is important that, we don't have too deep a recession. Otherwise this could become a systemic problem, if you get difficulty on the financing side.
That's right. I mean, again, countries rightfully took advantage of low interest rates in some instances for very productive investment in their countries. And nobody would have anticipated a pandemic coming their way and upending a lot of this. But the reality is we are where we are. and for that purpose, we have to just be honest about where we see debt levels. That begins, in my view, and I think in something that we're working a lot with the World Bank on, but also several countries, is full debt transparency. So transparency in the obligations governments have taken on, and being honest about what is debt or debt-like, right? So there's been a lot of financial complexity. The instruments themselves have gotten a lot more complicated over the past 10 years as financial innovation has taken hold, even in lower income countries, quite frankly. And that means that it begins with an honest assessment of what obligations have people taken on, what are the nature of those contracts, are they collateralized, and what does that mean if the contract is in default, what is triggered, and then kind of setting in place the institutions within countries to have good, sound public financial management. In other words, what projects or investments are worth borrowing for? How much can you afford to pay for certain types of, just like you would in a corporate planning kind of setup, which investments are likely to make your return hurdle given the cost of your financing. This is obviously extremely complicated for countries to handle, and for a lot of countries, the availability of funding over time has been more plentiful than the advice they've taken in on trying to build up some of this technical capacity. So obviously a lot to work through. We're hopeful that we're going to make progress in what the DSSI allows us is a bit of a breathing room for countries, but also for us and the World Bank to kind of assess how this pandemic plays out, what kind of interruptions take hold, what kinds of debt levels are sustainable in the future, and then working with countries on how to, for those that are unsustainable, how to move them to a place where their debt is sustainable and they can build upon that for future growth.
But as far as the IMF's lending policies, to, I guess, any country, you're really going to require, particularly if you're providing a large amount of resources, you're going to have some kind of assurance that the debt is sustainable. So debt reduction is going to be part of future IMF packages. If the country's debt is not sustainable, the IMF can't be lending into something where there's doubt as to whether they've got the capacity to repay.
That's correct. I mean, I think it's a lot of this is grounded directly in our articles of agreement that date back to the inception of our institution. But I got, a firm, a hard and fast principle here, right, is we aren't going to be the institution that lends into an unsustainable situation or ourselves over indebts the country. In other words, if we are the straw that breaks the camel's back, so to speak, we're not doing ourselves or the country any favors. And so that's why I think, earlier I may mention that sometimes a loan isn't necessarily the answer, right? More debt, there is a limitation as to how much debt a country should take on, including, quite frankly, from us. And we have risk management, robust risk management in place to kind of monitor and enforce that. I think it leaves appropriate scope for sound judgment based on what countries say think they can achieve and what we think they can achieve in terms of a structural reform that helps that is growth positive and therefore allows for a certain higher level of debt service over time. But I mean, I think we have to be very real. Again, the past few months hasn't exactly been positive from a debt sustainability perspective. The situation has worsened considerably in many countries, and this is going to be a challenge for us.
Yeah, no, I would totally agree. That when you see declines in GDP of something of the order of 10%, that seems to be the norm. Some countries higher than 10%. If you had a high debt level before, just arithmetically, that really explodes it. And then on top of that, what's happening is because they've got deep recessions, their tax collections collapse and their budget deficits rise. So, that's another source. So this is really going to be a real challenge going forward. Maybe if we could just turn a little the discussion to Argentina, how you see that situation. If you could perhaps mention how the fund is involved in that country, and what kind of lessons you might have learned, from the program, the past year or two.
Sure. I mean, we're, Argentina hasn't been able to escape the reach of the virus itself. So I think first and foremost, again, like other countries, people in Argentina are suffering, and this was on top of a situation where the economy was already in a pretty bad spot. This, the Argentine government decided to move ahead in negotiating with its private sector creditors a few months ago. We agreed to provide technical assistance to Argentina in that respect. So in other words, we're discussing with both creditors and Argentina where they see things and how they see an agreement coming together potentially. We're hopeful that one will. But we ourselves at the IMF are not necessarily party to, not even necessarily. We are not party to the negotiations themselves, and there's obviously a lot of conversation still ongoing between both sides, and I think there's again, I'm a hopeful person. We hope that an agreement is reached soon. We think it's in the best interest of both parties that an agreement is reached relatively soon, and that can again provide a basis by which And I think the creditors would agree, as well as Argentina, that we want the Argentine people to succeed. We want them to see more growth and be more prosperous, and that begins with seeing some kind of agreement on the debt.
Yeah, but I guess once again got the problem with Argentina with holdouts that this is rather difficult, or is one in a better situation now that one's had collective action clauses in the new loans?
I think we've benefited from some of those innovations and collective action clauses and otherwise. It doesn't make this necessarily an easy exercise, I think, for either side. I think both sides rightfully have a lot at stake and are trying to do their level best in delivering for what they need. But again, I would just kind of go back to what we ultimately want, and as an institution at the IMF that wants higher global growth, Argentina is a part of that, and that means getting the agreement on debt. We would hope in place soon, but also having a sound policy framework that allows Argentina to grow and prosper and interact with the world down the line.
Right. One question's come in that somebody's asking, what weakness, if any, has the pandemic exposed in the economic structure of the EU? I don't know whether you can say anything to that.
I don't know if I'd point to one necessarily at the moment. I think there's been a lot of action taken by the EU and its various institutions. They have pandemic financing facilities. The ECB obviously is considering additional actions after having already taken quite a few. I think the real challenge for the world, but I mean, by Europe is no exception, is how do you get back to growth after this? So in other words, this was growth in Europe was sluggish going into this, going into the pandemic. And that just makes it all the more difficult to bring together the right policies to kind of grow out of the pandemic. Just to get back to the run rate that you were in January is going to require extraordinarily more effort than you anticipated even back in January to get growth going. So that's certainly, again, not a challenge that's limited to Europe, but I think one that Europe's institutions are going to have to face head on in the coming years.
Yeah, well, I guess that one of the problems in Europe is that different countries, within the euro have got more fiscal space than others. So, the Germans have got more fiscal space than the Italians. But it's encouraging with this new arrangement that they're putting up, in the amount of something like 750 billion euros, that they look like they might be moving somewhat towards more of a fiscal union where growth will be more even, because this is not a situation that would seem to be sustainable from a long run point of view. You can't have one part of the union, the eurozone, growing at a very rapid rate and the other part totally stagnating. That's I guess a problem that's going to have to be addressed.
No, I think you're right, and I've read a lot of your work on this, and for those of you that haven't, read Desmond's research in this area, which is quite good. There are obviously age-old challenges in terms of some of these the institutions and what the European Union is an evolving, right, as we're seeing an evolving collective of institutions that will need to somehow adapt to provide for the growth that is going to be needed after this. I don't think it's just limited to Europe either. The pandemic is exposing weaknesses all over the place in terms of, for example, just speed of making decisions and being able to move quickly and put support in place. One challenge that we're going to face at some point is when the right time to remove or recalibrate policies makes sense. And so in other words, the policies that made sense in April or May in the depths of a lockdown may not make sense in August or September when you're in a different phase of reopening and see your labor market and capital markets and financial conditions differently. If banks, for example, are able to lend into a recovery, having gone into this crisis with a lot more capital, we may need to assess, right, what kinds of financial support are really available in the marketplace and where the government sits on that. So again, not limited to a European discussion. I think it's something that institutions globally are going to face.
No, there's no question that we've never seen anything quite like this. It's not simply the severity, but it's the speed at which things happened. As you were saying, that at the end of last year, we were viewing the global economy one way, and 2 months later, it was an entirely different problem. What also has to be very challenging, from your point of view, is that we're really going into uncharted territory, that we've never had unemployment levels this high, and that it's likely that it'll stay high for a while, that's got to pose challenges, in terms of budgets and in terms of deflation and so on. But we're drawing to a close. So, what I want to do is really thank you for a really open and frank discussion. It's really been very enlightening, at least to me. And I don't know if you want to just say a word in closing, that would be great.
Well, thanks very much, Desmond. This has been a great conversation this morning, this afternoon, I should say. And glad that we were able to get some of the questions in from those that are viewing from wherever they are, at home or elsewhere. I think the one thing, you kind of put it well at the end, is we are in uncharted territory, but that doesn't mean that we don't have things to guide us on what works. The same things that guided us going into the pandemic in terms of how you get growth and how you help people to be better off still hold. So in other words, responsible institutions, good governance, transparency and accountability, sustainable fiscal frameworks or in spending, monetary frameworks that are well understood and, protect the purchasing power of people. I mean, you can think of all these things that, the rule of law and contracts, these are all things that we're going to, healthy banks and financial institutions and capital markets, these are all going to be needed on the other side of this to finance us back to not just the run rate we were at in January at the end of last year, but well beyond that. And so we should have an eye towards how we reinforce these policies and institutions as we think through what is unique about the pandemic and what we uniquely have to put in place as a result of this latest shock.
Well, it remains for me to once again thank you and to wish you and the organization the best of luck, that you really are in a very central place, and our prosperity and the prosperity of our children really are in your hands. So thanks again, and maybe we can do this in 6 months' time and see where we are again.
Thanks, Desmond. I look forward to coming back.
Okay.
Great.
Thank you very much.
Thank you.